Hey everybody, it's Mike from Taxes and Bricks. Welcome to episode 18. Today we're going to wrap up our conversation about the last two aspects or types of itemized deductions. We're going to talk a little bit about medical expenses. I'm going to give you some rules about deducting medical and some examples of qualified medical expenses. And then we're going to talk a little bit about a couple of miscellaneous deductions. There really aren't a lot anymore since the Tax Cuts and Jobs Act went into effect, but we're going to discuss two of the sort of most common that I will see and that most people might encounter. I'm going to leave some of the less common deductions, miscellaneous itemized deductions to the side for now. But first, got to pay the lawyers here, so stay tuned real quick for a quick disclaimer, and I'll be right back with you.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, welcome back. Thanks for hanging in there for that disclaimer. All right, so we've talked in a prior video about charitable contributions. We've talked about mortgage interest. We've talked about the SALT deduction. Let's talk a little bit about medical expenses as an itemized deduction. Let's talk a little bit about gambling losses, and we're going to talk about casualty and theft losses really quickly. So medical expenses, hard to deduct. They really are. They have to exceed 7.5% of your adjusted gross income. So using a mathematical example, let's say your AGI is $100,000, you got to have over $7,500 in medical. If you have less than $7,500, you're not getting a deduction. Okay, so not everything you have in medical is going to be tax deductible. What's included in part as a medical deduction? Well, it's got to be a valid medical treatment. It's got to be recognized as a common actual medical treatment for, in the common world for whatever illness or ailment or condition you have. It's got to be used to treat, prevent, and cure a valid medical condition. And typically it's got to be diagnosed and then recommended or prescribed by a doctor, okay? Most things that are over the counter, not going to be included. What does out of pocket mean? Out of pocket's another big one. You have to be out of pocket for the deduction. You can't be reimbursed by an FSA or a health savings account. It can't be free. So like people who went and got the COVID vaccine or free COVID testing, or other free treatments that they might get, they're not out of pocket. There's no cost, so there's nothing to write off. Out of pocket basically means insurance didn't cover it, wasn't reimbursed by an FSA or an HSA. You actually paid money for it and you never got reimbursed. You never saw that money back again, okay? What kinds of deductions are allowed for medical? Well, again, we talked about this. A doctor's got to say you got some kind of a medical problem, an issue, a disease, an illness, a condition, an injury, something like that. And then the expenditure, the treatment, the expense has got to be to actually, cure, prevent, deal with, treat that condition that the doctor said you have. So in addition to things like co-pays and doctor's fees and prescriptions and, physical therapy treatments and certain first aid type supplies, like you had to get a cast put on or something like that, mental health. In addition to all of those, you may have insurance premiums you pay for that your employer doesn't provide. So you have insurance, you don't have insurance through your employer, and they provide you with insurance. They don't provide you with insurance, so you buy it yourself, and you're out of pocket for that. That would count as a medical expense. You've also maybe got vision or dental or hearing care that you pay for that your employer doesn't pay for or isn't pre-taxed through your W-2. That would be part of your medical deduction as well. Over the counter, like I said, no good. So things like vitamins, aspirin, Band-Aids, no. Okay. Plastic surgery for cosmetic reasons, no. If I don't like my nose, I can't walk into a doctor and say, give me a new nose. I don't like my nose, and pay him $10,000 and they give me a new nose. That's not valid medical. If I have an issue that requires medically for me to have some kind of cosmetic surgery, I think of things like somebody who's a burn victim might have some skin grafts or skin reconstruction. Certain people who go through certain cancers may have some reconstructive surgery to fix whatever the cancer may have kind of damaged. In that case, because the source, the reason, the cause was a valid medical issue, that might be allowed. Medical travel, something that's not super common. If you travel and you're traveling for valid medical reasons, say, for example, you have a specific condition and there's no doctor in your immediate area who treats that condition, so you fly to another state or another country to have that treatment done, you may deduct the cost of your travel. Airfare, coach usually is all that's allowed, or up to the cost of coach if you fly something else. You can take a bus or train, rent a car when you get to that location. Meals, never allowed, no matter how long you're there and no matter the reason. Lodging, no matter what you spend, you're never allowed more than $50 a night. So if you spend $20 a night for lodging, ew, but whatever. Okay. But if you spend $20 a night, you get $20 a night. If you spend $800 a night at a really nice hotel, you get $50 a night. How many people can you bring with you on travel? Well, if you are unable medically to travel on your own, you're allowed up to one person as a companion, and you can pay for their airfare and their local transportation and their $50 a night for lodging, et cetera, et cetera. What about, let's say, if you're injured, you're in a wheelchair, you alter your house, put a ramp, lower the counters, install an elevator, something like that. You get a deduction to the extent that the improvements you make to your house do not improve the value of your home. So, really quick example. I am in a wheelchair, let's say, and I have to put an elevator in my house, and I spend $50,000 to do that. Okay, if the expenditure increases the value of my home $50,000, I don't get anything. If it increases the value of my home less than $50,000, I get the difference between what I spent and what it increased the value of my home in terms of the amount. So, quick example. My house is worth $100,000. How do I know that? Well, because before I went ahead and installed this elevator, I did what I was supposed to do. I brought in an appraiser. You're supposed to do that. Bring in an appraiser. Appraiser says your house is worth $100,000. I'm like, okay, nice, awesome. I now drop 50 G's. Put in an elevator. I hire that same appraiser or somebody similar to come back, and afterwards he comes back and says, "Hey, good news! Your house is worth $120,000 now." Nice, great. I improved the value of my house a little bit. So really, I'm only out of pocket, according to the IRS, $50,000, which is what I spent, minus the improved value or the increased value of my house, which would be $20,000. I get a $30,000 deduction. If the appraiser comes back and says, "Mike, your house is worth $200,000 now," I get nothing. Because the $50,000 I spent actually kind of made me money in theory, so I don't get any deduction for that. Okay, so that's medical in a nutshell. Remember the 7.5%. It's got to be valid medical. Okay, you got to actually pay for it out of pocket. Can't be reimbursed. Can't be covered by insurance. Okay, it's got to be medically necessary. And for things like travel, went through that, and things like improvements to your house, got to make sure that it doesn't increase the value as much as what you spent or more, and then you get a tax deduction. All right, let's talk about gambling losses really quickly. This is a miscellaneous deduction, one that actually we kind of see relatively often. Gambling losses are deductible to the extent that you have gambling winnings. So let me give you an example of what doesn't qualify. Go to somebody's bachelor party, go for a weekend, a bachelorette weekend, whatever. You just go to a casino because it's a day that ends in Y. Okay? You drop $1,000 at the blackjack tables in 5 minutes, and you walk out of there with nothing. You didn't win anything. You didn't win anything before that, during the months of the year before that, and you didn't win anything after that in the months of the year. So all you did in the entire year of 2021 was you walked into a casino and you lost $1,000, you get no deduction. That's not what this deduction is for. This deduction is designed to help you offset only the winnings that you might have. So really easy example. Let's say, throughout the course of the year, every day I stop at the same gas station on the way home and I buy a $1 lottery ticket every day of the year without fail. I've spent $365 on lottery tickets, assuming it's not a leap year. And in that case, then I would have spent $366. But $365 all right, dollars in a normal year on lottery tickets. And on the last day of the year, I scratch off the lottery ticket, okay, scratch off ticket, okay, and I get, silence that phone, I get $400. I won, woohoo, that's great. So I claim the $400 on my return as income. I'm allowed to write off the $365 that I spent to win that 400. I'm still going to show a positive income of $35 on my returns. Why? Because you're allowed to write off up to what you win or what you spent, but never more. So I can't write off $800 worth of lottery tickets. I didn't buy them, number one. But in the reverse example, let's say I spent $365 on lottery tickets and I only won $100 on that last lottery ticket of the year. I'm not allowed to take the $365 as a deduction against $100. I'm allowed $100 out of that $365. Why? Because your lottery losses, your gambling losses, are deductible to the extent that you have winnings. $100 in winnings, I'm allowed up to $100 in losses. $500 in winnings, if I've spent $500 to win that money, I can write off $500. Basically, I can get it to zero so that the winnings and the losses net out to zero as much as they can. That's it. Okay. Casualty losses. Casualty losses are kind of tough, and they're not super common, but they're there more so than most of the other sort of miscellaneous deductions. So a casualty loss is defined, and this is what the IRS says, as damage, destruction, loss of property from sort of a sudden, unexpected, unusual event, such as a flood, hurricane, tornado, fire, earthquake, volcanic eruption, maybe even a blizzard, some kind of natural disaster, maybe some kind of act of terrorism, something like that. A theft loss is defined as the taking or removal of one's property or money with the intent to deprive the owner of it. The taking must be illegal under the law of the state where it occurred, and it must have been done with criminal intent, okay? So, a couple of things that you got to remember here. Number one, if you're reimbursed by insurance or you're made whole by insurance, you don't have a loss. So, I don't know, somebody breaks into your house and steals all your stuff, and they steal $20,000 worth of stuff, and you file an insurance claim, and the insurance company comes and gives you 20 grand. Well, you were made whole. You don't have a loss. Same thing with the casualty loss. I don't know, a hurricane comes through your area and blows the roof off your house or something like that, or knocks a tree into your property and does 20 grand worth of damage, and the insurance company comes in and gives you $20,000 to repair your house, or they just repair it and you don't come out of pocket for anything. You don't have any losses. Okay, it's only to the extent that you're out of pocket, sort of like the medical. Okay, if you're not reimbursed and you actually had a loss of value, or you had a loss out of pocket money wise, then you've got yourself a casualty or theft loss, and potentially you could, in theory, deduct it depending on certain circumstances and whether your income is XYZ. Income limitations do apply in certain circumstances. It also depends on the nature of the loss. So there are certain kind of looser restrictions with respect to things like the Ponzi schemes that we heard of, that made popular because of the Bernie Madoff issue a number of years ago. Ponzi schemes are treated a little differently. Usually get a little bit more in terms of benefit tax-wise for Ponzi scheme losses than you would for a normal casualty or theft loss. If you think you have a casualty loss or a theft loss, it's really a good idea, because this does get a little complicated, to sit down with a tax accountant or a tax lawyer or somebody of that nature to kind of figure things out. So that in a nutshell is medical, gambling losses, casualty losses. Again, casualty losses, theft losses, gambling, not super common. Medical, we're going to see more often. The really big ones are things like charitable contributions, SALT, and mortgage interest. Those are the big ones that I see mostly, and we've already been through those. And that pretty much covers the series on itemized deductions. Thanks for joining me for episode 18. I really appreciate your time. A little bit longer video today than I had intended. Medical kind of takes a while to go through and whatnot. But thanks for hanging in there. If you like this video, go ahead and hit the like button below. Definitely subscribe and share with your friends. And stay tuned tomorrow, which is Thursday. We're going to go back to Lego. Hopefully, I think I've got a couple sets coming. Maybe. Maybe do some unboxing. If I don't get any of those sets, I'll figure something out that's fun and entertaining. So again, thanks for joining me. We'll see you again tomorrow.